On your screen, you can see a 5-year chart of the FTSE All World. So this is a benchmark for the global stock market. You can see if you'd stayed patient, stayed invested, you would have ended that 5-year period with more money than you started with. It's interesting because that period includes global pandemic, a massive increase in inflation, the fastest rise in interest rates that we've seen in a very long time, and so on. Over the last 12 months, those returns have also been still really good. So just to give you some examples here, 41% from the US stock market, you would have got 29% from Germany. Even the UK stock market, which everyone says is unloved and boring, have you got 15% return in 12 months? Really good. You know, it's better than you'd normally expect. I think all of this is really interesting because here's your list of things that people have worried about. This is just all I could fit on the slide. Could have gone many pages here. So over the last 12 months, we've had Middle East tensions, major elections, major changes on the political front. You've had lots of economic points going 1 minute saying things are fine, 1 minute things are not fine. You've had excitement about AI, and then people go, hang on a minute, you're spending all this money on AI. When is it going to show some positive financial returns? And so on. So you've had this big list of things to worry about. The bond market for the last 2 years has been saying things aren't very good. The stock market has been saying things are brilliant. So which is right? There's a signal in the bond market that was there up until about a month ago where longer dated US government bonds were offering a lower yield than short dated. You'd normally expect a high yield. History says that's an indicator that we've got a recession coming. The stock market has said, well, central banks have put up interest rates because inflation's high and they're trying to beat it. But inflationary pressures are easing, so they've started to cut. Stock market's been pretty happy, saying, we think that these cuts will avoid a recession and things will tick along nicely, hence why you've seen the stock market continue to go up. As always with investing, there's always people with different opinions and there's different signals even now with what's going on. I want to talk to you about 3 companies in the US which are really good barometers of what's going on, certainly from an economic point of view. First is UPS, so the delivery logistics company. Not a very nice share price chart. Arguably, you could say everyone ordered loads of stuff during the pandemic and then that pace eased off. So that kind of explains it. But listen to what it's saying recently, saying customers are opting for the cheapest possible way to send things. That implies businesses are worried about their costs. They want to keep an eye on costs. Whirlpool, for your fridges, your washing machines and stuff. I think if you ask most people in this room, over the years, if your washing machine breaks down, you probably just buy a new one. Whirlpool is saying that is not happening this year. People are fixing them. They don't want to splash out and buy a new one. Lamb Weston, maybe not a brand we know so much in this UK, but they're one of the major suppliers of potatoes for French fries for McDonald's. They're saying demand's not very good. Fast food, not good. Home white goods, not good. Sending things around America, not good. So all of these companies are saying, okay, maybe the bond market's been right all along. I wanted to put this up, I won't ask you to shout out, but just a little thought. Whilst we've got negative stuff, there's still plenty of good stuff. And it's a reason for you, if you're investing in the market, to be patient, stay invested. You probably look at this share price chart and go, okay, well, that's clearly one of the tech stocks. Yeah, and AI, anything AI, go through the roof. It's not. It's Ferrari. So I think, hang on a minute, I thought the car sector was on its knees. Well, Ferrari seems to be doing all right, judging by that. So when you're investing, it's trying to understand all the different dynamics. I thought if I put this into 4 different buckets, where things roughly are. Euphoria being where everyone's talking about excitement, AI, weight loss drugs. You would have made a lot of money in all these areas. If you go to the other end of the scale, up until recently, everyone was really pessimistic about China. Very negative, very pessimistic about commercial property. But there's movement in both those areas recently. China with the Beijing's talking about massive stimulus to get the economy moving again, moving even faster, I should say. Commercial property. Lots of companies are saying, we'd like you to come back to work, but not just a couple of days. We want you 3 or 4 days in the office. Interest rates are falling. So all those bombed out commercial property stocks are starting, people going, oh, maybe I should have a look at that again. Some investors, particularly if you talk to fund managers, they say they like to look where it's unloved. They say, look in the waste paper basket. So if you've been bold enough, there is movement that side. But equally, there's still plenty of reason to get excited here. So when you're trying to make investment decisions, I think it's quite a nice little test to think about where might that sit at the moment. Here's just a few examples of what's done well. And just a reminder, we had that big list of things that are worrying people. Well, over the last 12 months, you'd have made 155% in Rolls-Royce, which is amazing. You don't get that on cash in the bank. 108% in NatWest. Well, NatWest will probably give you 4% on cash. But if you own the shares, you've done very well. And in the US stock market, Nvidia, I'm sure we'll hear a little bit more about that later. But not everything does well. I mean, it's really important to remember that investments go down as well as up. BP, Prudential, Diageo, all names that people over the years say they're boring, they're stodgy, they will always have a nice place in my portfolio and make me money. Not this year, but it's a reminder that investments have bad years and they have good years. Which brings us to 2 live issues. I say they're live, even though both of them have happened, because we have to try and now work out what are the implications of everything that was announced. And there's one common thread here, and that is they've changed expectations for where interest rates will go. And that matters to all investments. So the UK budget, initially, a lot of fear about what they're going to fiddle with the tax system. The budget wasn't as bad as people thought. And then the next day, you suddenly saw really big movements in gilts, which is UK government bonds. It's because it became clear that whilst the government had found ways to essentially plug what it calls the black hole in public finances, bringing more tax income. That tax income, massive increase, is not going to happen immediately, but it wants to borrow a lot more money to invest. And so government bonds in the UK, the yield shot up, which is essentially the price of them fell. The bond market is saying, we think that interest rates are now going to stay higher. Partially, another reason is to link to the budget is because the increase in the national insurance for employers, it's going to push up their costs. I mean, you heard some of the supermarkets today talking about it could be really big. Of course, when companies have more costs, what do? Pass it on to you and I. And what's that? Inflation. So we had a situation where the stock market's saying up until a few weeks ago, interest rate cuts. And we're still getting interest rate cuts now, but the pace of them could slow. In the US, Donald Trump has won the US election. His policies will drive up inflation. With tariffs coming down on immigration, employers in the US are going to find that they're going to probably have to have much bigger wage bills. Any companies that have been importing goods from overseas, well, those goods are going to have tariffs slapped on them, so they might either have to pay more for them, or Americans are being encouraged to buy stuff from American companies that's going to cost more, so it's going to get passed on to the consumer and to businesses. And so we've also had a change in US government bonds, treasuries. So those yields have gone up as well. Interest rates might stay higher for longer. So this complicates things. So I think that is going to be top of the agenda now. Whilst Donald Trump says he's going to do lots to drive the economy, it's not going to be that clear cut. So if you looked at the stock market reaction yesterday on the news, very positive across the board. So things like banking was a really big sector to move. Names like Citigroup were moving like 8% in a day, which is something you just don't really see in the banking sector. That's linked to Donald Trump says you're going to loosen regulation. Joe Biden wanted banks to hold more cash as reserve. Now they might not have to do that. So he wants to encourage things to do more with the oil and gas companies, make it easier for them to get permits to do more drilling. So you can see there's still segments of the market that are moving fast, but house builders fell a lot. That's linked with the prospect of consumers facing new inflationary stuff. Interest rates staying higher for longer means that mortgages won't be coming as affordable as perhaps people were thinking a few months ago. So all of these going on. So it just means that your worry list you saw there for 2024, well, you better get a piece of paper, get ready for a new one for 2025. But that doesn't mean it's a terrible time to invest, because there are still really good companies on the stock market. There are still lots of opportunities in the bond market. It's all about identifying where they are. If you feel confident enough to do this on your own, obviously it means you have to do quite a bit of research to try and join the dots. If you don't feel confident, well, there's actively managed funds. You have fund managers, you're paying a small fee for them to do all the hard work, or you can look at tracker funds that simply just mirror certain parts of the market which you want to track. Have an investment plan, stick to it. There's lots of noise around and your worry list is there, but they've always had a list of worries. What you don't really want to do is to try and second guess every single thing that's going to go on, because if you're buying and selling, you're racking up trading costs all the time, and that's just going to eat into your returns. You know, my personal preference is I put a little bit of money into the stock market, into my ISA, my pension every month. If the stock market's racing ahead, the set amount of money that I'm putting in will buy fewer shares or fewer fund units. Stock market's going down, my money will buy me more things. Over time, it will average out. And I think that this idea of, if you don't need the income at the moment, use that cash from dividends or bond coupons and reinvest them, because that's a really powerful driver of investment returns over time. So we will have some fund managers talking about different parts of the market in a second. We'll have this Q&A. Please do ask some questions afterwards. But we'll all be here after the event as well. So we're going to go next door, and then we'll have drinks and canapes. Please do come talk to us. We'd love to know what's on your mind. Share your experiences. You know, whether you're new to this, you're just starting, you've never invested, or you're doing it for a long time. We'd love to know, and talk to each other as well. So thank you for the opportunity for us to present here.